Good morning. I'm Brian Curtis.
And I'm Doug Krisner. Here are the stories we're following today.
The House has elected to authorize an impeachment inquiry into President Biden. Dan Schwartzman has the details in New York. Dan.
Yeah, Brian, it has just come down. They have authorized an impeachment inquiry into President Biden. The vote, of course, going strictly on party lines. All 221 Republicans voting in support. All 212 Democrats voting against. Authorizing the impeachment inquiry now guarantees that the investigation will go on well into 2024. Biden, of course, running for re-election most likely against former President Donald Trump. Speaking of Trump, U.S. District Judge Tanya Chutkan has granted former President Trump's request to pause the 2020 election obstruction case, which is scheduled for trial in March, as Trump presses the claim for immunity against criminal charges. The former president is appealing Chutkan's earlier ruling, which denied him immunity for events that took place while he was president. The judge has said her order to pause the case was just to hold on the schedule, and depending on how quickly the immunity issue is resolved, the original dates could still be revived. Japanese Prime Minister Fumio Kishida telling reporters in Tokyo earlier today he is reshuffling his cabinet. Reports have emerged that he would be firing 4 ministers after a scandal rocked the ruling Liberal Democratic Party. The 4 ministers on the chopping block, including the chief cabinet secretary and trade minister, are part of a group that have been accused of hiding income from fundraising events. Kishida says the changes to his government will be announced on Thursday. In a news conference in Tel Aviv, Israeli Defense Minister Yoav Gallant says the country will continue its war against Hamas until the terror organization is dismantled and all remaining hostages are brought home. Gallant's comments coming on the heels of growing international condemnation of civilian casualties in the Gaza Strip, including President Biden highlighting Israel's loss of international support due to what he called the, quote, indiscriminate bombing that takes place. Elon Musk, who moved to Texas during the pandemic, is planning to start a university in Austin. More on that from Bloomberg's Charlie Pellet.
That's according to tax filings for the billionaire's latest charity called the Foundation. The new institution, seeded with a roughly $100 million gift from Musk, will start with a STEM-focused primary and secondary school. According to an application to the IRS for the tax-exempt status obtained by Bloomberg, once it is operating, it, quote, intends to ultimately expand its operations to create a university dedicated to education at the highest levels. In New York, Charlie Pellet, Bloomberg Radio.
Thanks, Charlie. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Dan Schwartzman, and this is Bloomberg.
Let's take a look now at the hour's top business stories. Well, as Doug mentioned earlier, the Fed has left interest rates steady and gave its clearest signal yet that the aggressive hiking campaign is done. The dot plot implies no rate hikes and, in fact, 75 basis points of cuts in 2024. Fed Chair Jay Powell, however, insisted that the projections are not a preset plan, as he said inflation is still too high.
We are prepared to tighten policy further, if appropriate. We're committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we're confident that inflation is on a path to that objective.
Still, Powell said that the FOMC has begun discussing when to ease policy. He said most Fed officials now see the risks to price growth as broadly balanced.
Stateside, hedge funds and brokerage firms have some new requirements on certain transactions involving trading in U.S. Treasuries. Today, the Securities and Exchange Commission voted to require all transactions involving so-called repurchase agreements to use clearinghouses to complete them. Here is SEC Chair Gary Gensler.
There is a lot of borrowing leverage in the Treasury markets. Bringing things into central clearing can address that in a number of ways. One is the clearing itself does something called multi-party netting, which lowers a lot of risk in the system.
That is SEC Chair Gary Gensler. Now, the Commission said the new central clearing mandate would apply to Treasury transactions in both the cash and repurchase markets, and the new rules could also bolster oversight of highly leveraged positions, such as the so-called basis trade. Those trades, by the way, do use the repo market. Brian?
Well, Citigroup is offering to pay some staffers a portion of their bonuses early if they agree to leave the company voluntarily. Let's get the story from Bloomberg's Sally Bakewell.
City can make less layoffs as part of this broader restructuring that it's unveiled in September. And it's also hoping that staffers will see this as the lesser of two evils. If they kind of cut and run by taking part of a guaranteed bonus now, if they get caught up in, that's better than getting caught up in the likely and anticipated extended cuts next year when they could end up with no job and no bonus.
Bloomberg's Sally Bakewell. Citigroup has already cut more than 300 senior management roles as part of its September revamp.
We go to Tesla next. The company is recalling more than 2 million vehicles. This comes after the top U.S. auto safety regulator determined Tesla's driver assistance system, Autopilot, doesn't do enough to prevent misuse. Here's Bloomberg's Craig Trudell.
This dates back actually to August 2021 when the National Highway Traffic Safety Administration opened an investigation into Autopilot after several crashes into first responder vehicles. So there would be an existing crash scene that the Tesla would come up on and run into, say, a police car or a fire truck. And since then, actually, NHTSA has opened a separate defect investigation into Autopilot. There's been all sorts of scrutiny into these systems going back years.
That is Bloomberg's Craig Trudell. Now, Tesla said it's expecting to begin deploying an over-the-air software remedy to take care of the situation. Brian?
Well, with all the support that China's economy appears to need, it was a little surprising that China's November credit growth remained slow. Let's get the story from Bloomberg's Yvonne Mann in Hong Kong.
Aggregate financing rose 9.4% compared to the same month last year. That follows a streak of single-digit growth recorded this year and contrasts the double-digit expansion that was normal in previous years. Weak corporate borrowing and the slow rate of money supply expansion also worried economists. The collapse in the housing market has undermined credit demand from both developers and households. China's annual economic policy meeting said the expansion of credit and money supply should match growth and inflation targets. Some economists say that might be a signal for more room to cut interest rates and banks' reserve requirements in the months to come. In Hong Kong, I'm Yvonne Mann, Bloomberg Radio.
Chinese property developer Country Garden has surprised creditors. The company has made a full yuan bond repayment. More from Bloomberg's Joanne Wong in Hong Kong.
Country Garden's onshore unit says it has repaid a $111 million bond in full. The debt had a put option due Wednesday. It added in a filing to Shenzhen Stock Exchange that the debt would be delisted. We reported earlier that Country Garden Holdings representatives had remitted funds to fully repay the note's outstanding principal and interest. Sources say it did not provide any reason for the decision. But with its full repayment, Country Garden will avoid a first default on a local yuan bond. In Hong Kong, I'm Joanne Wong, Bloomberg Radio.
Joanne, thank you. 10 minutes now past the hour. This is Bloomberg Daybreak Asia. I'm Brian Curtis, and my colleague Paul Allen joins us now from Sydney. Our guest is John Taylor, Stanford University professor of economics and also Hoover Institution senior fellow, for a closer look at the Fed decision. Mr. Taylor, thank you so much for being with us. Fed Chief Jay Powell said that the Fed is now well into restrictive territory. That is totally new. Just 2 weeks ago, he said that it would be premature to say so. So what has happened in the interim?
Well, I think the language has changed, but what is important is they didn't give any indication they were going to move away from the goal of 2% inflation. And they reiterated that a couple of times. And so that means, I think that's an important thing for the markets to understand. They're not going to go above 2. They're going to keep it at 2, and that's something that they've agreed upon. The statement that they're a little bit on guard, I think they're always on guard, and I think that what's new to me is that they've focused a little bit more on making sure that there's a possibility of raising rates.
Yeah, so it's still not off the table. And one other thing that didn't change is Jay Powell saying, look, it's still too early to declare victory over inflation. When you look at the inflation picture, where do you think the Fed is in terms of the fight?
Well, first of all, don't forget that it was a year and a half ago or so, the inflation rate got over 9%. And the interest rate then was only 25 basis points, 0.25. And so they've made quite a bit of adjustments since then, and inflation has come down, I think, partly as a result of that. So the question is now, and it's gone so high that it's 5 0.25 or 5.5 is the federal funds rate. So the question is when they will reduce it. He made it clear that it wasn't right away. It would be next year sometime, and many of the prognosticators are indicating that it will be a decline sometime next year. And I think there will be, of course, that requires the inflation rate to come down a bit.
Should we be a little surprised that policymakers didn't push back with some of these market bets? And they could have done so with the dots, because we all know that the dot plot is not really a plan. It's just projections. And it seems like since they didn't push back with, the dot plots maybe suggesting that there was still, some hikes to come, that might suggest that they really are confident they are done.
Well, I think they are confident they're done. They're hoping that the inflation rate, don't forget this 2% goal is still there, and they've made some projections that the interest rate will be coming down in 23 and 25 and 26. But it's still not all the way to 2, and so it's a little more gradual than you like. But I think that's true. One thing that's good about the meeting is they've said there'll be lower rates next year. They even said to some extent through the dot plot how much that'll be. But the main thing is they didn't indicate a reduction right away, and I think Powell made that pretty clear. It's not really ready for that.
Yeah, so we've got the dots indicating 75 basis points of cuts next year, but
Correct.
The market pricing in 150. Why the divergence? Is this hope on the part of the market, or is there a credible reason for the disagreement here?
Well, the market could be, there's so-called Taylor rules, named after me. He's 30 years old, and the Fed publishes that in their reports, and they talk about it all the time. It could be that the market is looking for a little bit more on inflation than the Fed has indicated is going to happen. The Fed may be a little bit cautious. I think it's okay for the Fed to be cautious. 75 basis points or so in 2024 is quite a bit. They might have to do more than that, but they didn't say it'll be less than that or more than that. They say that's the best guess, and that's come from the dot plots. It's really not a commitment of any way, shape, or form, but it's a direction of that I think they're likely to go.
So it's not a massive about face, but I wonder whether or not with this kind of change that it would worry some investors that, all of a sudden the Fed has changed to this degree. Do you think that might get reflected in market action?
I don't think if you look at it carefully, the Fed has not changed that much. The chair has pretty much been on the same page, at least for the last 5 or 6 days. The notion that they're going to reduce rates is pretty clear. They've stated that. The notion that the current rate is 5.25 to 5.5 is still there. And so I think in some sense this is not a surprise, but you're right, it might be some people are taking it that way.
But John, I mean, we just 2 weeks ago, just before the blackout period, I mean, here's the direct quote from Mr. Powell. It would be premature to conclude with confidence we have achieved a sufficiently restrictive stance. Yet today he said we're well into restrictive territory. Is that not a big change?
I think the fact that he clarified that we may have to go the other way, if you read carefully, he did say that. Yeah. And to me, it's not as big a change as you might think. I actually do rely on this so-called Taylor rule, which is published there quite a bit. And they've followed it for a while. They were off a while. Now they're getting back to it. They're very close at this point. And according to what the projection is, it's going to continue that way through the next year and a half. So I think that's the thing to keep in mind. The Fed itself keeps it in mind. The chair has referred to that several times, but not today.
Does what Brian's saying, though, an indication of a possible communications breakdown? How has the Fed's communication been, in your view?
I think it's actually improved, if you like. Right now, with this rate 5.25 to 5.5 or so is about where it should be given the inflation rate and given the state of the economy. It's beginning to come down. Remember, it was not that long ago the inflation rate was very high, 9.1%. Now it's come down quite a bit. It's not a 2. It's not a 2, and we have to make sure the Fed has not changed its commitment to a 2% goal. And so it's moving in that direction. And so I think there's not as much change if you read through the lines that you're indicating. They're basically on their way down. They're doing it in a managed way. I think they could do a little faster, but they're doing it in their own managed way, and I think that's the right direction to go.
Well, I asked about whether the market might react in a certain way. We did see a big drop in yields. Now, that doesn't necessarily mean that people are extremely nervous. But with the 10-year here, 10 years right at 4% now. I mean, it's quite shocking that in weeks we've moved from 5%, a little above 5%, to 4.01% on the 10-year. The 2-year, I can understand, it's really tied to Fed policy. But this is a pretty big move down to 4% for the 10-year. Do you expect that this is kind of an overshoot at the moment, or is this just the beginning of a lot more to come?
Let me say, I hope it's not an overshoot. I think 10 years is quite a ways out, and you can think about the rate maybe should be somewhat higher, but not much. Who knows 10 years from now? But here you have to be very careful to take the rest of the world into account. The ECB has just begun to come down. There's a new governor of the Bank of Japan. There's a question of Latin America. And so the Fed has been wise to begin to lead the way. Remember, just a year and a half ago, they were at 0.25. And so it's quite a change. They're well behind the curve. Now, you could argue they're too far ahead, but I think they're just about right. And if they continue on this mode, then it should work out quite well.
So we've got a 2-year at 4.426, the 10-year at 401, so still inverted. When do you see that disinverting?
I think it'll happen over the year. If the Fed continues with the path they've indicated, and I know I've said it a couple times already, but the so-called Taylor rule is out there, and it's in their publications, and they all know about it, and other central banks do too. And so what has changed, I think, in the last year and a half is a more adherence to that. We have not seen the discrepancy that existed 2 years ago. They're really pretty close now, and as the inflation rate begins to come down a little bit further, then they'll continue with that reduction in the rates.
So we've talked a lot about the Fed, not so much about the economy.
Yes.
What do you think about the path of the economy here? Because, tied to my earlier questions, some people might say, maybe they see something that we don't see. How do you feel the economy is churning along at the moment?
I think the economy could be doing better. Here you need to think about fiscal policy as well as monetary policy. You need to think about regulatory policy as well as monetary policy. You think about our overall policy with respect to the dollar, with respect to our international. But I think the opportunity for the economy to grow more rapidly is there. And I think that should be the focus. As the Fed continues with its efforts to bring inflation down, there should be a renewed effort to keep growth high. And I think that has to do with the regulatory policy, it has to do with fiscal policy. It's not just monetary policy, but monetary policy has to be consistent with that. But I think we shouldn't let that maybe 3%, 3.5% goal go away.
This is Bloomberg Daybreak Asia, your morning brief on the stories making news from Hong Kong to Singapore and Wall Street.
Look for us on your podcast feed every day on Apple, Spotify, and anywhere else you get your podcast.
You can also listen live each day on Bloomberg 1130 in New York, Bloomberg 99.1 in Washington, Bloomberg 106.1 in Boston, and Bloomberg 960 in San Francisco.
Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130.
Plus, listen coast to coast on the Bloomberg Business app, SiriusXM, the iHeartRadio app, and on Bloomberg.com. I'm Brian Curtis.
And I'm Doug Krisner. Join us again tomorrow for all the news you need to start your day right here on Bloomberg Daybreak Asia.